Welcome to the deep dive. Our mission, well, it's pretty simple. We want to give you the analytical shortcut.
Mm.
We cut through all the daily noise you see in today's sources to give you a really focused, high-level analysis of what's truly impacting economics, finance, corporate life, and state power.
Yeah, the goal is clarity. It's orientation. We're trying to prioritize the so what of it all, not just the headline urgency.
Exactly.
And today's deep dive, it's structured around this massive financial tension we're seeing in the sources. On one side, you have global defense and conflict costs they're institutionalizing, demanding huge sustained capital.
Okay.
But then on the other side, the U.S. domestic economy is having a sort of identity crisis. Is it a recession,
Yeah.
soft landing, or could it be a whole new AI-fueled boom?
That is the crucial conflict, isn't it? You've got this predictable geopolitical risk driving just immense guaranteed spending.
Right.
And at the same time, you have these incredibly volatile tech bets that are supposed to be driving the U.S. financial future. We have to square those two forces.
So let's start with that first part. Let's look at the escalating cost of global instability.
Okay, so we begin with a pretty sobering assessment on the Ukraine conflict. Analysts who focus on Russian political and military goals, they're basically concluding that Russia's plan to stabilize things by early 2025 is effectively a non-starter.
A non-starter.
Yeah, and that's not just a tactical note. It has enormous financial priority.
Because if stabilization is failing, then the current level of military spending, the aid, all that capital commitment, it stops being a temporary expense.
Exactly. It becomes a permanent, institutionalized budget item. It means prolonged, sustained defense spending for NATO allies and for Russia itself.
And you can see that reflected in the sources, right? They mentioned countries like Estonia.
Precisely. Estonia, for example, is actively strengthening its military ties with the U.S., through persistent lobbying on Capitol Hill. For the defense sector, this just translates into a guaranteed flow of capital.
Right, into armaments, long-term maintenance contracts, aid packages, all of it.
All of it. It almost removes market instability from the equation for those defense contractors. I mean, think about it. Consumer goods, they suffer when interest rates go up or a recession hits.
But not this.
No. Defense spending is driven by state necessity. These are long-term procurement cycles, decade-long contracts sometimes, completely insulated from what happens quarter to quarter with consumers. That sustained government demand is it's a huge anchor for the whole sector.
And this military capital allocation, it just accelerates even more when we look at the rising tensions between the U.S. and China.
Okay, what are we seeing there?
Well, there's a recent Pentagon report. It says China is dramatically speeding up its nuclear readiness, preparing specifically for, and this is the quote, pre-planned nuclear response options.
Wow. Okay, so as someone focused on corporate finance, that's where you start tracing the cash flow. This kind of tension, it demands massive competitive capital deployment. We're talking about specialized defense tech, advanced AI command systems, better missile defense infrastructure, the digital resilience you need to manage a modern nuclear arsenal.
And the beneficiaries are pretty obvious.
The U.S. military-industrial complex and all those specialized tech contractors, yeah, their growth it's almost totally decoupled from the wider economy.
Because their biggest client, the government, is driven by existential threats, not consumer confidence.
These are fundamentally risk-mitigated investments. It's a different world.
It is. Now, if we move from these huge state-level conflicts, you can see how political gridlock blocks even smaller, but still necessary flows of capital.
You're talking about the Middle East?
Specifically Gaza. The sources are reporting on the Netanyahu government's veto of proposals for managing reconstruction and humanitarian aid funds.
Right, I saw that, including a proposed $100 million from the UN.
Exactly. But the veto itself, it isn't really about the $100 million. It's about the signal it sends to every major investor, every international lending institution.
It's political disagreement creating economic paralysis.
That's it. That veto directly prevents international capital from flowing in for rebuilding and stability.
Yeah.
It basically guarantees the economic crisis continues.
It's the ultimate risk-off signal, isn't it? I mean, why would any private capital commit billions to rebuilding infrastructure or trade routes in that region if the political environment can just veto even a small humanitarian fund?
They wouldn't.
Stability is the first requirement for capital. And this tells the market that the foundation for stability, it just doesn't exist yet. That ensures long-term economic stagnation for the whole region.
And that political gridlock overseas, it stands in stark contrast to a very swift, very defining regulatory action taken here in the U.S., one that instantly reroutes billions of dollars.
Okay, so let's pivot to that. We're talking about the Trump administration's move to withdraw the Obama-era regulations.
The ones targeting coal-burning power units and the toxic heavy metals they produce.
Yeah, this is a huge policy shift. It really favors the old economy sectors. But let's break down the immediate financial impact for you, the shareholder or the capital planner.
Go ahead.
The old regulations, they required these coal-dependent utilities to invest massive amounts of what we call CapEx, capital expenditure.
Right, into specialized equipment.
Exactly. Expensive scrubbers, cleaning up decades of coal ash waste, which, has mercury, lead, arsenic, all that stuff.
So when those regulations are withdrawn, that financial pressure just vanishes instantly.
Right. Utilities like Samson Energy, Appalachian Power, West Virginia Power, they can just halt or scrap those projects, avoiding billions in mandated pollution control. That suddenly turns into a massive immediate increase in free cash flow, a stronger bottom line. It's a huge financial lifeline for them.
So the winners are crystal clear.
Yeah, the coal-dependent power companies save billions. But I have to ask, while they get this immediate relief, doesn't this kind of regulatory instability, the constant threat of rules being reversed every 4 or 8 years, doesn't that discourage any long-term capital investment in U.S. energy? Clean or dirty?
That is the essential question. I mean, the clear losers here are the companies invested in renewables who suddenly face less competitive pressure.
Okay.
But the larger cost, that's borne by public health, by the environment. It's a long-term drag. And to your point, this regulatory flip-flopping, it inherently increases political risk.
So if you're a private equity firm thinking about a $5 billion power plant,
this reversal suggests your entire investment could be worthless in the next regulatory cycle. It makes long-term planning exponentially harder no matter what fuel source you choose.
that dynamic old industry getting a break domestically while these geopolitical demands drain capital overseas, that feeds right into the core macroeconomic uncertainty we mentioned at the top.
It does. It feeds into what boards and investors are facing today. The opinion analysis we looked at highlights 3 plausible but mutually exclusive economic scenarios.
And we have to analyze the evidence for each one because your investment strategy totally depends on which path we're on.
So, theory 1, the recession, the cool down.
Okay.
The evidence here is the sustained high interest rates. Inflation is cooling, yeah, but those rates are still squeezing credit-sensitive sectors, housing, auto sales.
And especially commercial real estate.
Oh, absolutely.
Yeah.
Where all that debt has to be refinanced at much, much higher costs. So this leads to a softening in Q3, Q4 GDP growth. Corporate profit entered to plateau. That's the recession argument.
Then there's theory 2, the soft landing. This is the market's favorite, the Goldilocks scenario.
The dream scenario. The hope here is that inflation just falls gently back to the Fed's target without a severe contraction.
Job growth continues, unemployment stays low, the economy slows down without breaking. It requires masterful pinpoint policy from the Fed, which is always a big assumption.
A very big assumption. But then you have the most disruptive, the most provocative argument. Theory 3, the new boom, the tech surge.
And this one hinges on 2 key things, right?
2 things. First, the really robust job growth we've seen over the last 18 to 24 months. That indicates some underlying demand, some resilience. And second, the rapid acceleration and adoption of AI, generative AI technologies.
The link between all those jobs and a potential boom it's crucial here. The theory is that AI automates all these high-volume, low-value tasks.
Right.
So your existing employees, they can dramatically increase their output. They don't get replaced. They get leverage.
Then that increase in output per hour,
yeah,
that's the productivity surge.
Exactly. And that could trigger a massive, prolonged cycle of capital investment and economic expansion across all sectors, which would then justify those huge Silicon Valley valuations.
Yeah, if that AI productivity actually materializes, it changes the entire equation. Now let's connect this back to our first 2 segments. The EPA rollback we discussed that influences industrial investment gives a stimulus to legacy energy. Meanwhile, the massive defense spending adds guaranteed, non-cyclical demand to the economy.
But it also introduces severe geopolitical instability.
Exactly. These opposing forces are what's creating this identity crisis for the economy.
Speaking of justifying Silicon Valley valuations, we really need a reality check on the actual tech engine that's supposed to be driving that new boom theory. We have some excellent coverage on the chasm between these wildly inflated stock prices and the operational road reality, specifically for robotaxis.
This is a critical discussion, especially for investors who are pricing in fully autonomous profitability. I mean, companies like Tesla, Waymo, Zoox, their astronomical valuations are built on one core promise.
Removing the human driver.
Right, which accounts for, what, 60 to 80% of a taxi company's operating expense?
The sources, though, they highlight that the actual operational shortcomings are, well, they're expensive, and they're really dampening those profit forecasts.
We're seeing real-world issues, vehicles ignoring red lights, getting confused by temporary construction, or just failing to handle complex city traffic.
And critically, these failures often require remote human operators to step in.
Teleoperators, yeah. They have to intervene constantly by remote control. And this is the financial killer.
It has to be.
Autonomy promised these incredible margins by getting rid of a driver who costs, say, $50,000 to $70,000 a year.
But if the fleet still needs a remote human backup,
You're often just replacing a $70,000 physical driver with a $40,000 road operator, plus the massive IT and operational costs of that remote facility.
the margin argument is just gutted. The high capital investment hasn't produced the promised efficiency. It suggests a much longer, much costlier road to profitability than the optimists baked into those stock prices,
Right, so that new boom driven by seamless AI services, it might be delayed.
creating a temporary drag.
But we are seeing aggressive countermeasures being taken at the component level. Counterbalancing that operational drag is some fascinating corporate maneuvering in the AI chip sector.
The absolute engine of the new boom.
The engine itself. We're talking about Nvidia, the market leader, striking a strategic IP and production deal with a competitor called Grok.
That deal, it just screams urgency. Grok is focused on these highly specialized custom AI chips. So Nvidia, already the giant in the space, is moving to secure their tech.
Potentially through licensing, maybe acquiring specialized IP. It just demonstrates that staying dominant in AI requires aggressive capital deployment. You can't just rely on your own R&D.
So they're not resting on their lead.
Not at all. They're spending aggressively and strategically to make sure they remain the critical bottleneck. The one that every company betting on the new boom, from robotaxis to Gen AI firms, has to go through.
It reinforces the idea that the tech surge is real, but dominance requires these hyper-aggressive capital plays to consolidate power and IP.
Exactly.
Okay, let's quickly synthesize the landscape we've charted today. We saw geopolitical tensions demanding escalating defense budgets.
Right, creating a sustained, powerful, non-cyclical demand for military spending across the globe.
Then we tracked a foundational shift in U.S. energy regulation that instantly relieved legacy coal utilities of billions in mandated spending.
Which sparked a kind of domestic stimulus for older economy sectors.
And finally, we saw this high-stakes bet on AI technology driving the entire macroeconomy toward a new boom.
Even as that same core technology faces these sobering, expensive, real-world hurdles on the ground with things like autonomous vehicles.
The sources really show massive capital flows converging on two totally distinct areas. First, military modernization, driven by China, Russia, and NATO.
And second, the concentrated, aggressive AI tech sector, led by companies like Nvidia. Both of these are just immense non-consumer capital sinkholes.
So as you observe the markets and the policy debates unfold next year, we'll leave you with this provocative thought to carry forward. Which of these converging capital sinkholes, the military-industrial complex, driven by state necessity, or the Silicon Valley innovation engine, driven by speculative promise, will exert the greater defining influence on the direction of the global economy?
That is the question.
It's the question that will define the next decade. Thank you for diving deep with us.